All right. Thank you so much for that introduction, Kelly. I really appreciate it. And thanks to all of you that are joining us today, either live or even in a future date by watching this recording. It's really an honor to be able to present weather and climate, basically, data and information to help you make decisions as we start to head in throughout the rest of the winter and into the spring as well. So, of course, it's always great to join my colleague and my friend, Ben Brown, who has certainly gone on to the University of Missouri now for a very, very great reason, and for him to take the time now to set this up, to organize this, and to still get back here in the university. So thank you, Ben. I wanted to make sure I said that today. So we're going to talk about the winter grain market and climate outlooks. I'll cover the weather and climate side of things. We're going to talk about basically where we've been, where we are, and where I see us heading over the next several months as we head into the 2021 growing season. My backdrop is where, what I wish we were seeing right now. I don't know how many of you snow lovers are out there. If you're a snow lover, let me know in the chat. Just say, yeah, I love snow. I wish we could see a little bit more. We did get some brilliant snow squalls last week. Think of these as pop-up thunderstorms in the summer, but instead it's in the wintertime, and we had a little bit of snow and grapple and things falling. So it was a very nice photo from Mary Griffith out in Madison County, Ohio. So thanks to her for sharing those as well. So where we have been, a little bit about more of a broad global assessment here. So 2020 for the globe is now the second warmest on record since 1880. So robust records going back to 1880. It's only behind 2016, which is the warmest year on record, by 0.04 degrees Fahrenheit. So essentially, statistically, these years are equally as warm, okay? It's one way to think about it, but technically 2020 is the second warmest, 2019 is the third warmest, and top 10 warmest years for Earth have occurred since 2005, okay? So there's no doubt when we look at the globe, things are warmer than much of the 20th century. So if you were born after February 1985, you've never experienced a cooler than average month for the planet. I think that is a phenomenal statistic, and something that just puts into context how long we've been dealing with these warmer than average conditions most of the time. So both what those temperature differences compared to average look like across the surface of the Earth here on the left, but also in time, that mean temperature for the year and how it's increased quite a bit, especially since the late 1970s. Now, one of the other things that we faced in 2020, and of course, with a year like 2020, we would see this, right, with all of the chaotic things happening to the world in 2020. We saw the most ever, at least as we've recorded them since 1980, billion-dollar weather and climate-related disasters. We saw 22 of them during the year of 2020. Now, previously, we had a couple of years that hit 16 of those events. And what's interesting to note is that if we look at a 1980 to 2020 average, the average between, for that period of time from 80 to 2020 is about 6 per year. But over the last decade, we've had a number of years where we see 12 to 16, and even like 2020, we had 22 of these events. And you can see we had a number of landfalling hurricanes, a lot of severe weather, heavy rainfall across the central portion, and of course our wildfires and heat. But the things about Ohio and the Midwest here, when we deal with these natural disasters, they're often through the rain-related interface here. We see a lot of river flooding, we see a lot of flash flooding, and those disasters are quite big because we're a water-rich region. We're not water scarce like they are west of the 100th meridian. Like we tend to even, our droughts tend to be shorter in duration. They are intense, but we're never far from flash flooding events either. So our face is really through that. Just something to keep in mind throughout much of the Midwest, that's the case, where we have, bountiful lakes and rivers across our landscape. So the 2020 Midwest growing season, was particularly interesting. I think, from a weather perspective, I think every season and every year is interesting. For Ohio, it was the 11th warmest March through November on record. And what I'm showing you here are the differences compared to daytime for the differences compared to our long-term mean, which is 1981 to 2010, for both daytime highs on the left and overnight lows on the right. So you'll notice there are a lot of areas that were average. That's the gray shading in those areas. But we had some above average conditions, especially here in Ohio, Michigan, and then stretching back towards some of the drier areas of Iowa and Nebraska this past season as well. You'll also note we have a lot more area covered by warmer than average overnight lows versus daytime highs. And that's something that we've seen over the last 30 to 40 years, is that our overnight lows are actually warming faster than our daytime highs. And so it's really reflected even in an individual season like this, where we can see the differences between those daytime highs and daytime lows. Of course, there were drastic differences between the seasons this past year. We had a relatively average winter across much of the Midwest, but very cold April and May, especially here in Ohio, where we had late freezes even into May, and then record heat in July. So a very warm July. And we actually set in some drought conditions, especially across Northwest Ohio, which just a year ago were unable to plant because it was too wet. So the differences from 2019 to 2020 quite drastic in terms of the conditions that we've seen across that region. As far as the rainfall goes, again, a little bit more about that. Pretty close to average, I would say, for much of the region. Here in Ohio, much of the state was above average for this period of time, again, with drought conditions across Northwest Ohio, extending back through central Indiana and Illinois. Of course, we also had a drought out in Iowa, and the drought coupled with the major derecho event in August. Obviously, we've heard about and talked about, and Ben has talked quite a bit about the devastation, and perhaps the impacts of that were a little bit underestimated given the latest reports. So, certainly weather, it always has an impact in our lives, but this is kind of teasing out the things that we saw in 2020 to help us make sense of the season that we just experienced. So that's enough about the past, I think, for today. We want to turn our attention now to where we are right now, sitting really in the heart of winter. We are at the climatological bottom here in Ohio. Our average temperatures start rising from this point. If we look at over the last week, you see a lot of orange and reds across the entire Midwest. We have temperatures running up to 24 degrees above average in parts of Minnesota over the past week. Here in Ohio, we're looking at the northern half of the state, really 6 to 12 degrees above average, between 1 to 6 degrees above average across our southern counties there in yellow. Over the last 30 days, it's pretty similar. So much of the state up to 8 degrees above average for the last 30 days, and much of winter going back to Thanksgiving. We're looking at temperatures that are up to 8 degrees above average. This has been a mild winter. We've had some seasonally cool days, but our overnight lows have been really warm. As a matter of fact, tonight in Ohio will probably be our coldest night of the year so far, where we drop down into the mid to upper teens. So another kind of year where we've not been able to get a lot of that cold air. And a lot of that has to do with the snowfalls I'll show you in a moment. Over the last 30 days, this is what precipitation has looked like. Again, we had drought conditions that extended from central Illinois up through northwest Ohio last fall. And those dry conditions have really remained. There's been a little bit heavier precipitation north of that, heavier precipitation south of that over much of northeast, southwest, and southeast Ohio. So that's really, still a little bit below average for the last 30 days, but the lightest amounts really falling across our northwest counties in Ohio that are still under abnormally dry conditions according to the U.S. Drought Monitor, as I'll show you in a moment as well. So if we look at precip over the last 7, 30, 60 days, we again see a lot of the orange and red shadings, indicating that the percent of normal precip is below average. Until you get out, for instance, this week, quite a bit of precip across Iowa, Minnesota, South Dakota. But here in the Eastern Corn Belt, pretty dry over the past week, some light precipitation, and really over the last 30 days from Missouri upwards to Northwest Ohio and then up into Michigan. pretty dry conditions where many of us are running 50 to 75% of normal, even below that where you see pockets of red. And over the last 60 days, it's been a warm, dry winter, which is interesting when I show you when we get into the projections moving forward, because a warm, dry winter is certainly not what I had talked about in our last Outlook meeting back in October. And again, we'll get into that. I'll keep that cat in the bag for now. We'll talk about that in a moment. So I mentioned the snow analysis, which is critically important for cold air during the wintertime, especially when we get to the heart of winter right now. When we look at the amount of snow across the region, it's really confined, the most snowfall is really confined to Minnesota, Iowa, northern Illinois, and up into Wisconsin and the UP of Michigan right now. And that's pretty typical. But even up there, these amounts aren't quite as deep as we've seen many years. But you see a large portion of Montana through the Dakotas, Nebraska, Kansas, Missouri, Illinois, Indiana, Ohio, where we barely have any snowfall around. And so we have had a weakened system, a weakened Arctic polar vortex, which oftentimes allows for some cold air to really penetrate down into the US. Up until this point, it's really been shifted towards Siberia. It's been really cold in that hemisphere, but not a lot of the cold air has been able to penetrate and really be sustained across the US anywhere south of where we see that deeper snowpack. And until we get some deeper snowpack across much of the Midwest and the Eastern Corn Belt, we're not likely to see a sustained cold air outbreak, because with the ground surface open, you've probably already noticed that the days are getting a little bit longer because the sun's getting a little bit higher. And so it becomes even more difficult to start accumulating snow that sticks around for a long time from this point forward. So that will likely have a mitigating impact on how much cold air we see. Doesn't mean we won't see cold air outbreaks, because I believe we will. And we could see some good snow from it too, as I'll talk about in a moment, but it just depends on the timing. But this is why currently our temperatures have really not dropped too much. So if we're also looking at the water equivalent, I mean, a lot of these areas don't have a deep snowpack that helps recharge some of the soils as we head into the springtime and thaw begins, especially across the Dakotas and Nebraska and such. And so there's some concern, because these areas are already in drought, that conditions could lead to even more intensifying droughts over large portions of the Great Plains in the Midwest this upcoming season. So there's certainly been an impact on our soil moisture. If we look at our current soil moisture deficits, both from really from two different products here. We use an algorithm type, what we call leaky bucket model, to look at soil moisture ranking percentile here in the bottom left. The red, obviously, across much of the West really stands out. I mean, if you look to Arizona, they basically had their warmest year and driest year on record. I mean, we've got the drought, really intense mega drought setting back into the Four Corners region. But it's really kind of extended now into Texas, parts into Kansas, Nebraska, even Iowa, holding on to drought conditions here. Western Iowa holding on to very dry conditions this winter, and then up into the Dakotas as well. And again, kind of our hangover from last summer's drought still creeping around, and now we're starting to actually spread a little bit more soil moisture deficits in parts of the Tennessee Valley and even eastern and southeastern Ohio. And the other product here is a NASA product. So, they have some pretty good agreement between the two, as you see, a little bit different in the spatial comparison. But generally, what we're looking at is a large expanse of the country, especially the western half of the U.S., that's certainly well embedded in drought. And Illinois, Indiana, Ohio, even Kentucky and Tennessee, I don't think it's going to take much that we could get into some rapidly drying conditions if we remain dry heading throughout our upcoming spring. So that's something that I'm watching closely. I'll give my professional estimation and opinion here, but it certainly bears watching, especially since we've had a dry winter up until this point. One of the other impacts that we look at with this is from a stream flow perspective. Now, these are the river gauges across the country. We do have river gauges across Iowa, Minnesota, the Dakotas, and Montana, but those gauges are frozen out right now. So until they thaw, we don't get good readings in those regions. And even once you get thaw, you can have elevated, ice jams and things like that. But here farther south across our region, we're really starting to pick up on some stream flow deficits, or at least flows that are below average and below normal. Again, extending from central Illinois up into northern Indiana, but even parts of northwest Ohio, stream flows are starting to drop a bit, and so are they in southwest Ohio. Again, just indications to me that we've got some changing conditions, even here in the heart of winter, that are lending themselves toward drier conditions, at least for the moment. So this is the current U.S. drought monitor that was released yesterday, valid through past Tuesday here. Again, extreme and exceptional drought areas across the Four Corners region, extending out through Colorado, western Kansas and Nebraska, and then also up into the Dakotas and parts of Iowa as well. And really, the story of this summer will be how much that shifts toward the east, how much through Illinois, Indiana, and Ohio. And I'm a little bit concerned because we have it coming from the west, but now we've got parts of Kentucky and Tennessee that are showing up abnormally dry. And those tend to be the areas where drought moves into our Eastern Corn Belt region. This is just a little bit closer snapshot of where we are currently. Again, a handful of counties, Williams, Fulton, Lucas, Wood County, Henry County, Sandusky, and Ottawa counties that are in D0 or abnormally dry. Not official drought, but they're still dry. And I had a story from Bruce Clevenger up in Defiance County. He's the area leader for extension and extension educator for Defiance. He was watching them put a sign in this week using a pretty big auger, and that soil was just crumbling throughout that whole depth of putting that sign in. So we do have clear, visible signs now of the dry conditions that are really sticking around here for Northwest Ohio. All right, so that's sort of the conditions where we are now. So a little bit unusual. We didn't expect here in the Ohio Valley to have a dry winter. We were anticipating a warmer than average winter, but certainly not on the dry side of things, especially after we got past the first of the year. So it's been a little bit unusual to have a fairly dry January. But what lies in store here, and what are we likely to see in the coming days and months? So we'll just start with this week. We've got much cooler air that's filtering in today and tomorrow. We've got a cold front coming through with some flurries and some lake effect showers here across northeast Ohio. And we've got pretty cold high pressure that's going to settle in. Again, probably our coldest night of the year tonight. Here for Ohio, but we have a big storm that's kind of coming up together between a low out in Colorado and some energy that's going to eject from the Gulf of Mexico. So as we head into Sunday, we've got a pretty nice precipitation maker in the offing. Now there's some questions about the type of weather that we're going to see. I think where that rain snow line sets up, this could be a pretty heavy rainmaker for some areas that really need the moisture, from central Missouri through Illinois, Indiana, and into southwest and central Ohio. North of there, probably some moderate snowfall as well. So this is something that, in the very near short term, we're going to watch over the next couple of days. And then next week, kind of seasonally high, seasonally average highs, cool conditions kind of resuming behind that as well. Stuff we typically see this time of year. But this is, and it may be a sign of this switching pattern toward a more active pattern. This is something we've been waiting to see. We had one storm come through a little while ago, dropped some good rainfall about 2 weeks ago, but then, things shut off again. We haven't been able to see that La Nina pattern, as I'll show you in a moment, really kick in this winter so far. Which is interesting because if you look at some of the other worldwide impacts from typical La Nina conditions, it's been a little bit odd. It's been a little bit strange in other parts of the globe as well, considering we're in this moderate to strong La Nina event. So the next 7 days, much of the precipitation in southern Ohio, a good inch and a half, which will be beneficial. A little bit more, quite a bit less probably across northern Ohio, where we see the more of the threat of snow and potential ice accumulation. but getting any moisture right now is a good thing. We've not recharged those soils yet like we expected to. So that's what we're looking forward to here in the 7-day. So I've already kicked it around. La Nina, what does it mean? So really, what we're looking at with La Nina conditions is we turn our eyes to the sea surface temperatures between South America here and Indonesia over here. And we look at these sea surface temperatures, and when they're cooler than average, which this is what the plot here on the bottom is showing, anomalies just means the difference compared to average. So we're looking at anywhere from 1 to 3 degrees C cooler than average sea surface temperatures, all right? What happens is the tropics are very important drivers of atmospheric circulation and weather patterns that get established across the Earth. When we have these changes in the tropics at the sea surface, that has impacts on those atmospheric circulation patterns. And for a La Nina condition, typically what that means is that we get the impacts that you see here in the upper right during our winter season, really kicking in January, and then January, February, March, and even continuing into April. You get a highly variable polar jet stream. So you can think about a big high pressure system over the North Pacific. It allows some warmer air to really push up into the Arctic, and then some colder air often spills down. And depending on how far that comes down into the south, that is a question. I mean, we do see colder conditions across the northern tier of the US, but oftentimes it does allow for impacts from cold air across the eastern US. What it does here in the Ohio Valley, including the Miami Valley, is bring wetter than average conditions. So La Nina is typically a good pattern for precip, for an active pattern in a wet winter, especially after the first of the year. So this is why we were expecting, I was expecting wetter than average conditions, especially as we got into January. And so far, that's not really been the case. La Nina also has climate impacts and other times of the year elsewhere. For December through February, when we're looking at places like South America, typically the Amazon tends to be a lot wetter than average. Southeastern Brazil tends to be a bit cool. And typically there are not strong December through February impacts in a place like Argentina, typically speaking, right? There are other times of the year where it does have a little bit more of an impact, but during their summertime, right? On average, it's pretty close to average. And there's a really nice paper about also across parts of Mato Grosso in Brazil, looking at it's such a highly diverse biome environment that it's hard to use these large scale climate modes to understand localized impacts. Okay, so there's some a lot of uncertainty there, but these are the general patterns that we see across the globe. So wet here in the Ohio Valley and other places across the South American continent as well. So for us, if we look at a combination of past La Nina events back to 1950 and the overall trends that we've seen, which include increasing temperature and increasing precip during the wintertime, our temperatures tend to be warmer than average with some cold air outbreaks depending on what the Arctic is doing, with temperatures also increasing through time. So La Ninas are getting warmer. Precipitation trends across the Ohio Valley, which you see here in the bottom left, are wetter than average conditions. So along with that, a little bit increase in the snowfall as well. So this was actually the same slide I used in October, which I said I expect soil moisture to recover well throughout the winter. Speaking, specifically about Ohio, I still hold on to this statement. I still think by the time we get into our spring planting conditions, we will have recovered our soil moisture. I'm not abandoning that thought right now, but come back and join us on February 18th, and we'll rekindle this conversation. But I do expect conditions to really pick up in terms of activity. So if we look at the next 8 to 14 day outlook from the Climate Prediction Center, taking us through about February 3rd, again, much of the central U.S. extending central part of the U.S. extending into the Ohio Valley, we have elevated probability of higher than average temperatures. Warmer than average temperatures across Ohio as far as precip goes. Here on the right, near average, most likely to maybe slightly below average, even at least through the first couple of days of February. Now, we do have that big storm that's coming in next week, which is not accounted for in these. This is for January 28th through the 3rd. So there's some signs that immediately following this storm, maybe we don't follow that with another major storm right away. But the idea being is I think as we extend it farther in time, we're looking now at the February outlook that was released yesterday from the Climate Prediction Center. We do expect, we have a greater probability of seeing above average temperatures, which really fits the pattern to this point this year, as well as with La Nina. And again, we're still holding on to these increased probability of above average precipitation. And for Ohio, particularly our western and northwestern counties. That area, because it's dry, has some capacity to take on some additional water. So as long as we're not dealing with extreme precipitation events, those soils are going to recover if this pattern does really flip and become reality here for us. As we start looking even farther, February through April outlook here, again, even a higher confidence in seeing above average temperatures across much of the country, and in particular here across the Ohio Valley, at least 40 to 50% confidence in above average temperatures, and a bullseye right on the precip right over Indiana and Western Ohio, where this period of time during La Nina conditions, which are expected to continue at least through March and April, and then perhaps start transitioning toward what we call INSO neutral conditions. It brings an active pattern. So I do think that by the time we get to April and even May, now this is the May through July outlook, we're still going to maintain this higher than an elevated probability and a good probability, especially 3.5 month lead on this, of seeing above average precipitation across the region. Now, if we're warmer, that's good. If we've got these wet soils again as we head into April and May, and we see some of those late season freezes or cool periods, that's when we start to get challenged on those planting conditions. Okay, so I still think based on the signs that I'm seeing, that by the time we get to our spring, we will have recovered any abnormally dry conditions from last season. It'll just depend on how far does the pendulum swing to the other side of things, which we know we do back and forth. Okay. All right. So in the last few minutes here, I really want to talk a little bit about the longer term trends. Again, from a decision-making standpoint, we can again go back to where we've been to to look at what our trends are overall with temperatures. These are the seasonal trends just over the last 30 years for the contiguous U.S. And in Ohio particularly, you'll see warmer than average or warming trends in our springtime, especially for our southern counties, northern counties during the summertime, and most of the country during the fall. We've really seen increases in our fall temperatures. During the summertime, because the Great Lakes are warmer as well, we don't have a cooling impact across the Great Lakes as much as we used to. And then springtimes, just earlier spring arrival, as I'll show you in a minute on some growing season length conditions. Our autumn nighttime temperatures have increased a good 4 to 5 degrees Fahrenheit over the last 30 years, just much warmer conditions in the fall. And of course, we start thinking about the benefits of this, right? Longer growing season. If I get planted late, I'm not necessarily going to see those early freezes later on. And so we can evaluate that. This is a station for Northwest Ohio as an example. Looking at the growing season length defined by two temperatures, 32 and 28 degrees. So the last 28 degree day in the spring and the first 28 degree day in the fall, the number of days within that period of time. We see up here in Fulton County in Northwest Ohio, we've increased a good 10 to 20 days between those events since 1970. And then if we look at the date of the last spring freeze and the date of the first fall freeze, a couple of things stand out. One, we're getting earlier last spring freezes and we're getting later first fall freezes, but the later first fall freezes are actually later than normal compared to the earlier spring freeze or the earlier last spring freeze. In other words, we're extending those warm conditions into the fall, and that's also highlighted by those warmer than average temperatures during the winter time or during the fall time. And then the other piece of this, just to keep in mind, is our overall increases in precip, both in winter, in all seasons, really, winter, spring, summer, and fall. And there's some regional differences around the state of Ohio, for instance, with fall being the really strongest trend that we've observed over the last 30 years. But then we get into situations where we can look at individual months, just the month of July, and we see this drying regime across northern Indiana, west central Ohio here. So we can get into a situation where we have wetter summers overall, we have wetter conditions overall, but during the heart of the growing season, we get these negative trends in precip, which can drive some seasonal water shortages and drought conditions. So very interesting things from a decision management standpoint when we look at these conditions. So if we take a look, for instance, at our suitable fieldwork days for Ohio, as reported from NASS, we can look at our April and October trends since 1995, and we've essentially lost 5 suitable fieldwork days for the month of April and the month of October. So that's obviously impacting any early spring work in our harvest season. Less so during May. We've lost a handful of days, 1 or 2 days, but we've actually increased our suitable fieldwork days for June. So is it so bad if we get planted in early June or late May? I'll leave that question for you to decide. But certainly I think, this information helps in our decision making. Doesn't mean every year is going to be the same, but certainly these are the trends that we're seeing here in Ohio. And finally, I'll end today with an international look in here. So this is the weather bulletin, weather and crops bulletin from USDA, looking at the latest report and some highlights. And I'll really focus, I'll let you see these here, and these slides I'm sure will become available. Some different conditions taking place across other areas of the world here. You'll see heavy rain there noted in Argentina and showers across Brazil. This is really a change in conditions coming at basically the last minute or the midnight hour here for these areas. So if we look a little bit closer from this report, in Argentina, there was some really unseasonable dryness, and we have a visitor with us today, so perhaps he can offer some a little bit more insight. But certainly, dryness was dominating key region of farming in central Argentina. But this past week, they picked up some much needed rain, really soaking these key farming regions, and so thanks, will really help replenish the soil moisture there. Similar conditions in Brazil, basically widespread showers provided some timely moisture for soybeans and other crops. So there are some pockets of dryness that still exist as we see everywhere, but overall, these areas are looking a lot better perhaps than they were 2 or 3 weeks ago in terms of moisture supply. So with that, I just want to thank you very much for your attention today. If you'd like, you could always reach out at my email there, wilson.1010@OSU. We also have our State Climate Office of Ohio website at climate.osu. And of course, I try to be active on Twitter and Facebook as well. So with that, I will turn it back over to Kelly, and thank you so much.
Thank you so much, Aaron. I am not seeing any questions at the moment, so I think we're going to move forward with Ben, and then for the webinar people, you can do all your questions at the end. So Ben needs no introduction since we all know Ben, but now Ben is a senior research associate at the University of Missouri with MU Extension and the Food and Agricultural Policy Research Institute. Prior to joining MISU, he served as an assistant professor of professional practice and agricultural risk management located in our department, the Department of Agricultural, Environmental, and Development Economics at Ohio State University. A native of Western Missouri, growing up on a diversified row crop and cattle operation, Ben was active in 4-H and FFA, leading to his passion for extension. Ben received undergraduate degrees from Kansas State University in 2015 in agricultural economics and agronomy. He received a master's in agricultural and applied economics from the University of Missouri, Columbia. His work focuses on farm risk management in the areas of policy, including commodity programs and crop insurance, grain market analysis and marketing, and agricultural finance as it relates to business decisions. Ben loves working with producers and agribusinesses as his career and spends his free time traveling or reading. Ben, it's wonderful to have you back with us. Thank you for taking the time to be here, and the floor is yours.
Thanks, Kelly. Really appreciate it. It's always exciting to be on a program with you all, and especially Aaron and my good friend Aaron. Normally this time of the year, Aaron and I are racking up lots of miles all across the state, and certainly we aren't able to do that this year, but this has been a nice alternative, and as a result, we've been able to pick up some people, as Aaron mentioned, all the way from the other half of the globe in South America. So there are benefits to this, but there are a lot of downsides. Certainly, it would have been nice to visit with all of you at our traditional meetings, the ones up in Jewell and Greenville and Seneca County and in Worcester and Washington Courthouse and Licking County. It's always fun to get out and about around the state, but this is how we're going to have to do it for at least right now. I'm going to cover the grain market outlook and snapshot as we look ahead to maybe even starting to think about decisions for 2021. I know a lot of farmers, at least, I know my family has, and I know there's lots of farmers have already started making decisions or have already bought seed related to the 2021 crop. So we're going to start that and kind of give you a little bit of an outlook as of today, as of the most recent information we have, and hopefully it'll be useful to you. And if you have questions, I'd take those at the end. So if I can get my screen to advance, there we go. So here's my outline for today. I want to talk a little bit about economic drivers, and then we're going to follow that up with all the things that I just don't know, which is vast, especially when it comes to commodity markets right now. I think there's a lot of things that are up in the air that could cause issues for us in the commodity sector. I'm talking about things like COVID, stimulus program payments. I think we've got some issues with African swine fever starting to pop back up again in China. I am not a doctor. I do not pretend to be on COVID. I am not a veterinarian. I don't pretend to be on African swine fever. And so we just got a lot of things that I don't know. We're going to follow that up with the January WASD key points, demand fundamentals, and then talk about acreage for 2021. So that's our agenda today. I'm going to move through some of this really quickly just to kind of get through and make sure we stay on time and get to your questions. I want to start off and talk about the money flow into the sector. So what you're looking here is this is the US dollar index. So the US dollar indexed against several other currencies around the globe. And what you can see is all the way back to 1986. Traditionally, the US dollar is putting in a cyclical high or low every 7 to 8, 9 years, somewhere in that mix. As you can see, we started to go down towards a low. It looked like we put the high in. In fact, I still think we have put the high in back in 2017. But then what prevented us from going further was we had the whole issue with Brexit and the European Union. People were leaving the euro, coming back to the dollar, pushed our dollar back up. COVID happened this year. We had some interesting exchange rate, scenarios around the globe where money was flowing to commodities that were, currencies that were deemed safe. That tended to be the US dollar, pushed up the demand for the dollar, but then we flooded the market with a whole bunch of stimulus programs. The more dollars you put in circulation around the globe, the weaker the dollar that gets, and our buying power, if you want to think about in terms of what we can buy internationally. And we are a major importing country of goods. And so those goods coming into the country become more expensive as our dollar weakens. So I put this up here just to kind of start that off and talk about, this has a major impact on commodity prices globally. And when we think about a new administration coming in this week and the signals that they're going to ask for more federal stimulus payments, that could put even further downward pressure on our dollar, at least in the short term. I want to compare that to the commodity sector and kind of draw the connection here. one of the indexes I follow is the Thomson Reuters Equally Weighted Commodity Index. Now, there's lots of indexes. Basically, think of an index similar to the S&P 500. The S&P 500 is a group of 500 companies, and that index just tracks the performance of that collective 500. Now, the difference between the index I'm showing you now and the S&P 500 is the S&P 500 is weighted based on market share, and so it's very highly tied to the top 10 businesses, basically. I like this Thomson Reuters Equally Weighted Commodity Index because it weights each commodity or 17 individual commodities equally, and they're rebalanced daily, they fit into this picture. But it's also heavily weighted towards agriculture, and so you can see for agriculture commodities or the crops, row crops, and sugar, coffee, cocoa. Makes up about 47%. Livestock then makes up another 12%. So it's very heavily weighted towards agriculture, but they are all equally weighted, which makes it really nice. So when we look at this Thomson Reuters Core Commodity Index, again, going all the way back to 1996 when it started, you can see the big run up in prices there in 2007, the price inflationary period, then the crash. They rebounded as global, we started to have global growth in demand of oil seeds. We had an ethanol boom here in the United States. It's then gradually worked its way down and pretty much maintained its position since 2014. However, you see the big drop off earlier this year as it relates to COVID. And then you can see it really rally back. Again, that's signaling our price movements within the sector, but it also connects to the dollar. The commodity sector and the dollar move opposite of each other. They have a very negative correlation, or at least this index to the US dollar has a very negative correlation. So as the US dollar works its way down, we get more pressure up on US commodities, and therefore attracts more money into the sector through speculation, managed money firms and other into the sector, which then pushes up our commodity prices even further. So if I step back and I take just net managed money, so these are all hedge firms, these are speculators somewhere in the globe that maybe just have money. They normally might put it in, let's say, an equity fund or even a hard asset or a stock. But now it's starting to attract into our commodities. And so what I'm showing you here is this is the sum, the net sum. So taking both the long positions or those that have bought positions in agriculture markets and the short positions in agriculture markets, and got a net position for Chicago corn and soybeans, hard red winter wheat, soft red winter wheat, and then Kansas City hard red winter wheat, all the way from June of 2006 to January of 2021. And you can see that here in the last 2-3 months, we've put in an 8-year high in terms of the net amount of managed money and long positions. So these are people that have bought positions into our sector. Now, one of the interesting things that this does is it does expose us to downside risk, because these people tend to be quick in and quick out. Okay, they're going where the money is. The last 2 nights, and even again today, we've seen our commodities fall. I think beans were down 22 cents. I think this morning when I looked, or at least just a few minutes ago. Most of that was driven by these managed money funds saying, hey, I am happy with the rain that Aaron just talked about in Brazil and South America and Argentina, and therefore I'm going to sell out of my commodity position, take the profit, and go invest somewhere else. This exposes us to a little bit of a downside risk. It helps us on the way up, but it also exposes us to more downside risk. So it is concerning, potentially, that we could see some people take some profit taking and exit the industry. I want to talk about COVID for just a second. And again, I'm not a doctor. I don't even pretend to understand all the nuances with COVID, but I want to characterize COVID in terms of what we're seeing in terms of government restrictions around the globe. That's what I want to try to do here, because it feeds into so much of what we do in the commodity sector, whether that's eating out at restaurants for livestock, whether that's driving for ethanol consumption, right? It feeds in. So what I'm showing you, and I just took these from the CDC website. I didn't do anything to them. I just took them from the CDC website. You can see that cases as of yesterday spiked again. That's that very last bar, but they have come down from our earlier blip earlier in the month. So our highs early in the month on cases, but our death tolls continue to rise. And to me, that's what's most concerning, because that's what, well, one, every loss of life is important, or, it needs to be taken seriously. But more so, that's what now a lot of our government restrictions, at least here in the United States, are using the death counts to look at restrictions of movement and other things. So we see that death toll really spike. It hit a new high, at least outside of that 1 week back early in April. And it is rising again. So the 7-day average did fall, but our 1 day total from yesterday, which is likely deaths due to Christmas. A lot of reports signal that we're entering into that Christmas cycle right now, could spur additional restrictions on travel, social distancing, what have you, here in the United States. So just keep that in mind. Here's deaths globally per 100,000 people. The darker the blue, the more deaths per 100,000 people. And you can see the United States and Mexico, and then several countries in Europe really, really having a hard time dealing with COVID. Several other African countries, less populated countries, and Australia and New Zealand doing much better with it. But here's what I want to show you. So the Oxford University has this COVID-19 government response tracker. Again, this is a function of school closings or schools only on remote learning. It's limitations on going to work. So stay-at-home orders. It's figuring in extra stimulus payments due to COVID. It's figuring all those in and putting it in an index. And again, the darker the blue, the more heavy the government restrictions. And so this is just a time lapse across the top from left to right, and then from the bottom left to right on the bottom again, all the way from January of last year to January of this year. So almost a full year in comparison here. And you can see that there was lots of government restrictions in June. We eased out of some of them by late summer, but now they're starting to come back again. Today, the reports out of Britain was that Boris Johnson has made comments that Great Britain or the United Kingdom will be in virtual lockdowns all the way through this summer. And so we're starting to see more and more countries go back into stay-at-home orders and economic shutdown as those death tolls continue to rise. So here's the United States COVID response system. It doesn't look like it's changed much from April, but it actually has. We had a pretty significant spike, or we had a blip up in November that changed our color on the previous slide. But that bump that you see there in November was some extra stay-at-home orders in Texas, Florida, and California. And so big driving states when we think about motor fuel consumption as well. So certainly COVID continues to have major impacts on our economic livelihood, not as well as our health, our actual health, physical health. So this also fits into restaurant sectors. I took the first chart there from Open Table. This is the percentage of walk-in and reservation orders and walk-in table compared to the year before. And so as of January 20th, what this graph is showing you is that walk-in and reservation orders, if you will, are down a little over 60% from a year ago. That's also feeding into the current expectations of restaurant owners. And so that's what the chart on the right shows. Every restaurant owner is asked, what is your expectation in the current as of today? And then, just down the road a little bit, three months, 5 months period, basically. The current index has turned south again. People are becoming more pessimistic about the current situations, again, with those rising death tolls and more stay-at-home orders coming into place. But the expectations index, so in the future, is rising. And I do believe this is due to the disbursement of vaccines. And so we do see that is some good news. I want to switch to the trade deal for just a second. So we just finished 2020, the U.S. trade deal, phase 1 trade deal that we signed with China at the beginning of January was on a calendar year. Most of what we talk about in agriculture is on a marketing year, but this trade deal was on a calendar year, and it asked China to make specific commitments to different sectors: agriculture, energy, manufactured goods, and uncovered goods, which was basically everything else. And there was no physical or no set target on those uncovered goods. But for agriculture, this meant that China committed to $36.5 billion in 2020. And it was an increase above our 2017 exports to China. Now, the interesting thing about the phase 1 trade deal is you could either, they're going to take either Chinese data or the US data, whichever is higher in terms of did they meet their commitments? So we have China's data as of now. We won't get the US data until the 5th of February, but at least using the Chinese data that came out earlier, China fell short of their goal by about 35%. So still really strong purchases. You've heard me say this before, but I tend to look at this as a glass half full instead of half empty. Really strong purchases by the Chinese of our agriculture sector, predominantly soybeans. I know we've got a lot of people excited about Chinese corn purchases, pork purchases, dairy purchases. It's predominantly been soybeans is what's really driving that, and the higher the price, soybeans really working into that too. However, they only reached 39% of their energy. Again, part of that's to reflect the lower energy cost, lower oil, and lower basically fuel sources, down for nearly almost 61%. Manufactured goods were only 60% of the target. And then again, like I said, uncovered goods did not have a target, but if we just needed to maintain what we sent them in 2017, we even fell below what was the 2017 baseline. So all this is to say is we're not going to meet the phase one trade deal. The deal had provisions in place. If the deal was not met, the U.S. could re-implement tariffs, and who knows what would happen if China would retaliate back or not. I'm sure that would have probably happened under the previous administration. I'm unclear how the Biden administration is going to treat that. Personally, I don't feel like he's going to back away from this. Everything he said is that he wants to keep China accountable, but I expect him to do it in a multinational approach with some of our partners around the globe. But I don't see him backing away from this, but I also don't see him punishing it. So some people might look at that and say, okay, well, what's the good of having an agreement or a deal if you're not going to hold them to the results? And I certainly think that's a realistic argument as well. But I think we still got more to see to come and play out of this. But again, I don't know. We could see some major changes in Chinese U.S. trade as it relates to this. And then finally, I teased at this a little bit earlier. We've got African swine fever starting to pop up again. Here's two headlines from this week. The first one was that Germany finds more than 30 more African swine fever cases. That's important for the U.S. in terms of export potential, because currently Japan, Russia, China all have export restrictions against pork coming in from Germany. Germany, as of last week, had been lobbying to lift those restrictions to allow their pork into the country. Now with these cases, my expectation is that they will stay out of those markets and allow U.S. exports to continue. The second one there is that China had found new cases of African swine fever in their pork supply, and it was actually in a fairly large pork facility, signaling that even with these high biocontainment facilities and a more modern structure to their industry, African swine fever was still finding its way in. What was even more concerning was that most people now, or the information coming out now, is that this African swine fever was actually a byproduct or a defect from some vaccines that they had been using to treat the pigs to keep them from getting African swine fever. And so, if China starts having issues with their hog herd, which they have rebuilt back very impressively, it has been impressive how quickly they have built back their hog population, but they can do that when hog margins are about $300 a pig. I guess we shouldn't be that surprised that they're building back as fast as what they were, and it's coming back in a much more modern, better system. But if they start having issues with African swine fever again, not only is that going to increase pork exports from the United States to China, but it could hamper our soybean exports into the Chinese market. And so just something to keep in mind. I'm certainly not saying this will happen. Again, I'm not a vet, so I don't know how serious this new strain of African swine fever is to the market. When we look at soybean meal domestic consumption within China, I'm just showing you this annually. It's been a pretty stiff and pretty reliable increase year over year in soybean meal consumption by the Chinese. You see the blip there in 2018. They really started having issues with African swine fever in August of 2018. Their hog herd took the big hit, and then it's been rebounding ever since. We are now exceeding what they used to consume in soybean meal. And part of this is due to those high profit margins of pigs. When profit margins of pigs get that high, people start really pumping protein, pushing protein in those feed rations. That's coming from soybean meal. The second thing is they have eliminated food waste as a source of feed for pigs. That might not sound like much because we don't do that a lot here in the United States, but for the Chinese culture and the Chinese people, that was a big deal. And so that removed that source of feed from their rations, allowed soybean meal to come in. The fact that I thought was interesting was that weekly soybean meal crush has exceeded 2 million metric tons 23 times in 2020, or did exceed 2 million metric tons 23 times in 2020. It only did that 5 times between 2017 and 2019. I think that's important and kind of crucial because African swine fever, like I said, hit in 2018. So there was periods in 2017 and early 2018 where they could have, but didn't. Very few times. So just something to keep in mind. Okay, I'm going to talk a little bit about South American production. We've got an Argentinian on the call, and so maybe they'll correct me for anything I said that's wrong. But these are the current estimates for both Argentina and Brazil soybean in the left graph, and Argentina and Brazil corn on the right graph. A couple of things that I think are just noteworthy. Due to acreage increases and even a strong yield, Brazil and Argentina both are expected to set new records Brazil is expected to set new records in corn and soybean production. That is something that I think is noteworthy. Most of that's coming from an increase in first crop soybeans and then a big increase in the safrinha crop, the second crop soybean mixes that we see. Argentina is pretty stable, very, very similar in production to the last couple of years. I'm going to point out one circle here, or two circles in the blue area. That is, the drought year in Argentina where they suffered, a really pretty strict downturn in their production. I don't think we're going to see that strong of a decline this year, but it is noteworthy that USDA lowered corn and soybean production for Argentina both. They only lowered Brazilian corn. They left Brazilian soybeans alone. I personally, normally Brazilian soybeans would be about 40% mature, or 40% of their crop would be mature at this point. We're only at 8% mature, so the crop is late. So I think it was a little bit early to start drawing conclusions about the Brazilian soybean crop. I'm comfortable with that 133 for Brazilian soybeans, but I also wouldn't be surprised to see it come in a million metric tons or two lower than that as we head through the growing season. I also want to just mention, here's Argentina's precipitation. Karen Braun put this out, and I just thought it was interesting. The first graph you see there was in 2018, so that drought year I talked about. You can see how their deficit grew throughout the growing season or the planting season, and then just continued throughout the spring, throughout their growing period. This year, we had a deficit emerge kind of in the middle over here. Aaron talked about a couple of weeks ago, a month ago, they were seeing deficits in rain, but they have caught up with some heavy rainfall this week, and then the forecast looks strong going forward. So, I think Argentina has the potential to have, a decent crop this year, even though USDA lowered their expectations for their both corn and soybeans. Again, just looking at the outlook, Aaron showed some of this. Here's Argentina's main soybean growing region. In fact, I'll circle it for you. Here was the abnormal dryness. So brown is where it's abnormally dry. Green is where it's a little bit more wet. But then here is, so you can see that some of their major soybean producing region was under drought stress. But then if you look at the forecast coming up, there's some much needed rain for that area coming, at least in the 6 to 10 day, and then even some in the 11 to 15 day outlook for South America. On the Brazil side, same story here. Here's Brazil's main soybean growing region. It was very dry the last month in Brazil. I remind you, though, that a good chunk of their crop wasn't mature, and so this is a critical stage for it. You look out the next couple of months, or a couple of weeks, sorry, not months, next 2 weeks, and there's some nice rain in the forecast for that growing area as well. So, I'm not ruling out a production decrease for Brazil. It was dry during a very crucial time in their growing season. but we'll have to see due to the lateness of the crop um, what the impact actually is on the back end. So let's talk about current conditions for U.S. agriculture, and I want to make sure I'm staying on time. Okay, I'm gonna have to speed up. Most active futures, this is just an index starting at last year on January 1st, and you can see the big buildup in corn and soybean futures prices. We had the January WASDE on earlier this month. It's always a big report because of the amount of data we get. If you're a data lover and geek like me, you know that the January WASDE always has tons of information and is usually a big market mover. And that was no different this year. Basically, this chart here is showing you corn and soybean yield and production, but then the top two bars there show January's NASS report, so what USDA released in January versus the average trade guess. And probably the biggest number that came out of last week's report was this, the yield, the corn yield right here coming in 3.3 bushels lower than what the trade was expecting. That caught everybody off guard. People knew that it was probably going to come in below that 175.8, but a drop that big was very surprising for a lot of folks. Ending stocks globally and in the United States also saw some surprises. In the U.S., stocks came down much more than expected by the trade. Soybeans were roughly right in line, and then wheat wasn't too far off, a little weaker, but well within the margin of error. But again, so it was these corn yield that had everybody excited. I'm gonna talk to you a little bit about grain stocks because I think grain stocks actually tells a better story of the equation, but certainly the yield was a big component. When we look at these grain stocks for December 1st, the trade was expecting almost 12 billion bushels of corn on hand as of December 1st, and it came in 629 million bushels less. That was a big number. In fact, that is a big number, historically big, relatively big, whatever you want to call it. That was a big number, and that's largely what the market responded to. Soybeans was close, wheat was close enough, right? If we go to corn, I want to talk about that yield for just a second. I drew, November to final estimates on corn yield all the way back to 1990. And 2020 was our largest shock to final yield we've ever had in terms of from November, roughly the end of the growing season, to January. We just usually don't see that big of yield changes. Got a lot of people asking why in this era of precision ag and all this technology, why were we so surprised with corn yield in November or in December? Not saying NASS is wrong. I'm simply just saying that we missed it. Everybody missed it. Especially when you look at, crop conditions. And so these are submitted by crop scouts, county extension folk, FSA. You look at these crop ratings here. Of course, we saw New Iowa is going to drop off because of their derecho and drought that Aaron talked about. But Minnesota and Illinois, their crop ratings stayed or improved during this season. However, when you look at their final yield, the biggest hit percentage-wise was Minnesota. It wasn't Iowa, it was Minnesota. By the way, these in the final columns are ranked by 2019 productions from highest to lowest. Iowa's our biggest corn producer. Illinois and Minnesota, even though their crop ratings looked good, they saw big declines in yield as well. So there was something about that crop, and it turned out it was ear weights that caused us the issue and caused everybody to miss this phenomenon, right? If we look at corn yield, here's just the historical corn trend for U.S. corn. The expectation for next year, what I would plug into my budget right now is 180.5 bushels to the acre. That's what we'll stick with until we get close enough to May and June that we can start saying, okay, based on planting time and weather, we can start making some changes to that yield. But that's what we'll start with for this year, 180.5. When we looked at the grain stocks, as I mentioned, were big shockers to the market. That 629 million bushel difference between what the trade was expecting and what actually was on hand December 1st. And when you look at that from a historical standpoint, these are all December stocks, so the average trade guess minus the December stocks gets us the shock. Black bars are a bullish surprise. Yellow bars are a bearish surprise. And as you can see, last year we had a record bullish surprise. We all thought that was really high. And then we followed it up with an even bigger bullish surprise this year, okay? this is why I want to say that I think the stocks report actually tells us a lot more information than just looking at the yield. So if we start with that, we were off by 629 million bushels in the stocks report. The trade had missed the yield by 288 million bushels. Basically, we knew it was going to be lower. It ended up being lower than what they thought. So there was 288 million bushels that can be subtracted out from the yield reduction. So if we take 288 from that 629, that leaves us with 341 missing bushels. And the answer to this is that is what the surprise was to implied feed use. Basically, we fed more than anybody was expecting. Not only did supply come down 208, or not only did they miss the supply part of it, 288 million, but we missed the demand side, 341 million. So it was really a demand heavy shock, if you want to think about that. Instead of the yield, it was really excess feed use and residual. So much for all this. We're not going to feed as many animals, or we're not feeding them as much. We ended up feeding them a lot. And so just something to keep in mind as we think about going forward. What does imply for total year-end feed and residual use? Again, if we can back out that feed and residual use for the first quarter of the marketing year, that comes out to 2.7 and some change billion bushels of feed and residual use. I've basically just taken it by the percent of what we've traditionally done in the first quarter by the different years. I tend to agree more closely with the final one there. We observed about 45% of our total feed and residual use used during the first quarter from 2014 all the way to last year. So I think we're going to be still close to that. But that still implies 6 billion bushels worth of feed and residual use. USDA is currently only projecting 5.6 and a half. So if you look at this, one of the big puzzles that I had from January's WASDE report was the signal was that demand had been a lot stronger than any of us expected. Everybody just focused on the yield, but demand was actually the big story of that report. And yet USDA lowered feed and residual use. The reason for that, they said, is higher prices would ration demand. I get that. I can understand that, but I still think that was I expect, I guess is what I should say, that feed and residual use will come up later in the year. And without giving away the punchline, I think it'll come from other use categories. But I do think feed and residual use will come up. Nonetheless, it drew down ending stocks further again in January. Again, 2020, 2021 is that red line in the middle. A very far cry on corn, all the way from those record ending stocks that we were projecting all the way back in May. 3.4 billion bushels now, 1.5 and a half billion bushels. You map this out in the stocks to use ratio to price. We're kind of right here in the middle where we're not really rationing demand yet with price, but we're starting to, right? A little bit further of tightening this picture up a little bit, and we're going to start rationing demand. If China comes in and starts buying corn again, or if Argentina has a poor corn crop as well, maybe Brazil doesn't get all of their second crop planted. We're not dangerously tight on corn, but we're tight enough that we could see some movement if a couple of things went in the right direction. On the soybean side, same thing. I'm just showing you the trend. We're going to start with 50.6 bushels the acre for 2021. Again, once we get to May and start seeing planting date and expected weather, we'll change that, but we're going to start with 50.6. We look at the December 1st corn stocks, really close, as I mentioned earlier. Came in a little bit over 2.9 billion. The trade was expecting 2.92 billion. So really close on soybeans. But we also drew ending stocks of soybeans down to 140 million bushels. Again, we've been working that down. We're very tight, historically tight on soybeans. There's only been a couple other times in the last 2 decades where we've been tighter on soybeans than what we are right now. So very little room for error on the soybean side. Any challenges or any troubles with South America this growing season, we could see some exciting things happen in our soybean market. So let me talk about some demand, because right now we're at the time of the pricing cycle, the pricing year, where demand fundamentals and then expectations or weather in South America are really driving our commodity market. So every time it rains in South America, we do see that little dip in prices right now. The same thing is true when we start getting reports about exports and ethanol production, soybean crush. They tend to have impacts on our markets right now, more so than other times of the year, because that's what the market's focusing on. When I start out with gasoline consumption, I've showed this chart many of times. Just basically, and I took off my 2020 forecast But if the red line represented last year, and you can see the steep decline in gasoline consumption, and then we've maintained about 10 to 12% below since then. You can see we've started out the year, that yellow line. We did increase this last week, which was a positive sign for gasoline consumption, but we do still remain about 12% below, and that difference between year over year has maintained in that range, and we haven't seen it improve. We have seen some softening as stay-at-home orders come back on, but then when we look at this in terms of ethanol production, it matches it very closely. We're still roughly 10 to 15% below year over year levels, and we continue to maintain those. And so the more we slow down the economy, the more we're going to continue to struggle with ethanol. But right now, things have continued to stay open for the most part. We have not, or how do I want to put it? We have not had drastic reductions in ethanol besides what we gave up or what we didn't recover from, I guess. My last graph I want to show you related to ethanol. This is a survey that StoneX did. I just pulled it straight from their slide deck and put it in here. It's their slide. They get all the credit for it. But they asked a whole bunch of clients back in April what they expected gasoline consumption to be throughout the year. And so that's these blue bubbles. Most people in the industry thought that gasoline consumption would get somewhere back around 5 to 4% down. The yellow bubbles show what actually happened. And you can see that we didn't get as far as what many people expected, but we haven't recovered as fully as what people expected either. And we've maintained, like I said, that 10 to 15% down week over week during this period. When we look at corn exports, this is kind of a messy graph, but what this is weekly corn exports. The black line shows you the weekly pace needed to hit USDA's current target. You can see that for the biggest part of the year so far, the blue line, which is 2020, 2021, was below that black line. We were not exporting corn near as much as what we needed to hit those targets. I think that's why USDA lowered the corn export number 100 million bushels this month. But the last couple of weeks, we've seen really strong, well above those expectations, as you can see right here in the middle. We've been exceeding that seasonal pace needed for corn exports. Currently, exports still remain, at least on an annualized basis, 61 million bushels below the pace needed to hit USDA's target. So I think we could even see a further reduction in USDA exports in a future month. We'll just have to see how that shakes out. But I wouldn't be surprised to see another 50 to 75 million bushels taken out of the corn export picture between now and August. On the world supply side, we are getting tighter on global corn stocks. China still has, at least on paper, a lot of corn on hand. Just given the price internally and what the Chinese government says they have in stocks or on hand of corn, I'm not sure that that's an accurate number, and maybe at some point in the future we'll see a revision down of Chinese corn stocks. But if you take the United States and China out of that mix, the rest of the world is at their tightest supply of corn all the way since 2002. So there is very low room for error for the rest of the world outside the United States and China. A couple of thoughts on why I'm not overly excited about Chinese corn imports. A couple of things for this. They did update their numbers recently to show that there is a production gap between what they produce and what they use of about 28 million metric tons. They import somewhere roughly around right now 10 to 12 million metric tons is what the expectation is, which is well above what they have been doing the last several years. But the reason I'm not going as far as saying they're going to start importing 28 million metric tons to make up for that gap is there's other feed grains, wheat, grain sorghum especially. They bought some more U.S. grain sorghum today. It showed up in a flash sale today. They can feed other grains instead of corn. They want to be self-sufficient in corn, and they don't want to flood their domestic market with corn. They want to help the Chinese people, and one of the ways you do that is you give them $10 corn, and they'll produce a lot of corn at $10. The other thing that was interesting is at the end of December, a Chinese report came out and kind of took heed at their ethanol strategy. We'd always been hearing about E10 ethanol in China. It seems like that has completely just gone away, which I'm not surprised. I never really thought it would take off. I never bought into it because, one, I just didn't think the Chinese people wanted it. It was something that the Chinese government were pushing, and they just never bought into it. But basically what happened in this report, or what was said in this report, is Ethanol is okay only if stocks aren't tight and if that corn and corn acres are not threatening food security. So you can read that as available corn to feed hogs, if you will. So I think China's ethanol sector could be down for quite a while. Again, that we can send them ethanol, but that would have been a user of worldwide corn. And I just don't see that growing anytime soon. On the soybean side, I took this the sales report came out right before this webinar. So I just took StoneX's slide and put it in here. But current sales are 21% ahead of USDA's export pace. That would imply that we're 458 million bushels below where we need to be or at least based on these numbers. We're not going to get there. We're not going to add 458 million bushels to our export picture because we don't have 458 million bushels of extra soybeans laying around. So, we could see some increases to the soybean export number on the balance sheet. But again, we're getting really tight. So we don't have a lot of soybeans to play with or send out. Soybean crush continues to remain real strong. The December report just came out last week, a week ago. January 15th. It wasn't as big as what traders were expecting, but it was the second biggest month we've ever had. October of this year came in at 185.2. That was the largest single month of soybean crush we've had in the United States. So to follow that up in December with another report of that size is really, really, really nice to the sector. Supports the need for soybean meal to feed livestock, if you will. All 4 of our months this year, September, October, November, and December, have set new records. So if you take this into account, basically this implies that we're going to use about 42 million bushels more this year than we did last year. And USDA is already up 35 million bushels over last year. So roughly about in line, but again, we'll have to see if those margins continue. I'm not convinced soybean margins are going to continue. What's been driving them the last couple of weeks is a demand for soybean meal, worldwide demand for soybean meal. Argentina supplies about 41 to 43% of the world's soybean meal. They don't export a lot of whole soybeans, but they export a lot of soybean meal. They've had trouble with labor strikes, drivers getting grain to port. They're having trouble getting grain to port just on their currency currency issues. People don't want to take soybeans to the elevator. They can't get people at the ports to load it out on boats. And so, the loadouts of soybean meal onto boats, that does not mean that they didn't have soybean meal that could go onto boats. That just meant that they didn't have the labor to get the soybean meal on the boats. It was down roughly 2/3 in December. So Argentina basically was out of the market for a while, allowed the United States to come in, drove up our soybean price, helped with crush. Crush margins have now come down on higher soybean prices. Basically, the input got more expensive, and so it weakened the possibilities and opportunities for U.S. soybean crush growers. But nonetheless, we will continue to see good soybean crush numbers. They just won't be the great soybean numbers like what we experienced the last couple of months. So now I want to talk about acreage for just a second, and I'll end here and then we'll wrap up. I'll be truthful. I am not really sure what to expect on the split of corn and soybeans for next year. You'll see in my slides I have coming up that I have not changed them from my estimates at the beginning of January, where I put them, for the year, basically. I have not changed them because both crops are competing for acres, and both crops, corn and soybeans, need acres in the United States. So if we start out and talk about available acres, basically principal crop acres, conservation reserve, so principal crops in the red, those are principal crop acres. CRP acres are in the orange, and then prevent plant acres are in the gray. If you add all those up, I can make a case of where we get to 342 million acres for 2021. That's 7 million more acres of principal crop, basically bringing 7 million acres from prevent plant, putting them back into principal crop acres. Keep in mind, we had, pretty high, given our historical numbers, of prevent plant in 2021, even though we didn't really have major weather issues. The market signals just told people that, hey, prevent plant can be an economical option, and people took advantage of that. So, I've got 342 million. If we take that as our pie and we start divvying that up, basically corn and soybeans are competing for 180 million acres. That's what they're competing against. They're competing for. Winter wheat acres are up, but they're mostly hard red winter wheat acres, meaning that that's not a double crop area for follow-up soybeans. We could see cotton come into the mix in some places, and then grain sorghum seems to be competing with soybean acres in the Western Corn Belt, Kansas, Oklahoma, and Texas. Talked to a lot of friends this week. They all signaled that they're going to plant a lot more grain sorghum, and they're replacing soybeans with grain sorghum. So, I think it comes down to what that split is. I've had it equal, 90 and a half for both corn and soybeans. USDA is a little bit heavier on corn than soybeans, but not by much, basically like 300,000 acres. IHS Market or Informa put out their estimates yesterday, and they put out that they're expecting 94.2 million acres of corn and 90 and a half million acres of soybeans. So they're going heavy corn, which was a big increase from their estimates just a month ago. So I think the acreage debate is still very much up into discussion. So let's look at the balance sheet, and that's that last column that you see there. A couple of things to point out. One, supply came down, and since September, supply has come down 1 billion bushels. We've taken the derecho into effect here. We've seen a drought, and this is now the yield decrease that we saw in January. But 1 billion bushels out of our supply side has some impacts when it comes to price. The second thing is demand continues to maybe lag, right? Like it's not exciting, the demand story, like what maybe a lot of people were hoping. Exports are sitting right there. And if I go back, you look at that export number, exports have gone up 225 million bushels since September, but I think that's too big of a jump. I expect that needs to come down just a little bit. Ethanol continues to be weak, and it wouldn't surprise me to see ethanol fall another 50 to 100 million. So if we take 100 million out of exports, we take 75 million out of ethanol crush. That's 175 million that I actually think fits really nicely into the feed and residual use category. So even if we get a feed and residual use increase, like I think we will, I think it's going to come from other parts of the balance sheet. So demand's pretty weak if you think about it in terms of that. When we look at next year, again, I'm keeping that 90 and a half million bushels in here. And again, it's one, wrong, I lost my arrow. 90 and a half million bushels. That might come in high, and I probably should think about revising that upwards, somewhere closer to like 91 and a half or 92. But it's one of those things that if corn acres go up, soybean acres are going to come down, and we've already got a really tight soybean picture on that side. And so we can't send corn acres too high up, or we're really going to shock our soybean market. So you look up and down this balance sheet, and the corn numbers aren't that great right now, but they are improving. On the soybean side, we've seen supply come down. Demand has been going up thanks to strong crush and export numbers. When we look at new crop, again, I'm keeping that 90 and a half million acres of soybeans in there. But you look down this balance sheet at 143 down here at the bottom, basically the same stocks that we've got right now. We have very little room for error on the soybean side. And this is probably a case where, if corn does take another 2.5, 3 million acres, we're probably going to lose some of these soybean acres, and this number down here gets even tighter. So whoever wins, corn or soybeans, wins the acreage battle. The other one's going to have a very bullish price scenario. But I can't sit here today and tell you which one's going to win the acreage battle. Soybeans certainly has the favor when it comes to profitability, but farmers love to plant corn. There's just a fact of that. So my key takeaways, several factors continue to add downside risk. COVID-19, South American weather, trade, those are all things that I think provide downside risk to our commodity markets right now. But the market doesn't seem to be paying attention to most of those besides South American weather. COVID and trade, I don't think the market's concerned about either one of those when it comes to some of the reports coming out, but they could if we start to see major changes there. Corn and soybean fundamentals have greatly improved, and current prices support that. I'll just say that if there's one thing to take away from what I said today, it's to take away that the price reaction that we saw last week with the USDA report was partially related to the yield reduction, but there was a very strong corn feed and residual use signal there that I hope people don't miss, because it could throw off our future expectations for the market. I do expect soybean prices in the next week or two, as Aaron and I both mentioned, rains in South America could or will, if they do come or forecasted to come, help that crop, kind of alleviate some of the fears that they're going to have a short crop. And so I expect some downward pressure on soybean prices in the next couple of weeks, but fundamentals still point to prices remaining well elevated. I don't think we're going to see a complete crash, so don't get skittish. But I do expect some softness like what we've seen in the last couple of days. Again, fundamentals moving out as well. Overbought contracts selling out and going to some other asset or equity market. And then 2021 acreage remains a key question. I wish I had a better answer for you or a better analysis, but profitability gives soybeans the edge. Spring weather always dictates which crops get planted more. If we have great weather, people just keep planting corn. But if we have really poor weather and a wet spring, I'm taking some of Aaron's guidance here, that could move that a little bit more towards soybean planted. But at the end of the day, farmers love to plant soybeans, so I'm giving corn the edge, at least right now, but I could be wrong in that. And with that, I just want to say thank you all for listening and sticking with us. Aaron and I always enjoy doing these, and hopefully we get to see you in person someday soon as well. So thanks, and I'll turn it back to you, Kelly.
Okay, Ben, before we sign off, we have a couple of minutes. We do have a question in the chat from Angela Shriver. Mm-hmm. And it is, did the more than expected feed use stem from holding on to animals longer than expected because of decrease in processing availability?
It could. That is a possibility. My personal belief was that the 2019 corn crop, which would have been a function of this, was light. The test weight was light. That's noted. We could have had some quality issues, some spoilage that went away. But when I think about the test weight, right, issue part of this, if we're putting it into feed use, we need more of it to get the same results. So I think at least my gut is telling me that it wasn't the physical quantities that was the issue. It was how much we were feeding because of the low test weight and protein content. So I think that was a case. Certainly, there is an argument to be made that we backed animals up, and so we fed them longer. But in those scenarios, I do feel like a lot of people, changed the rations. We also had the argument that we weren't feeding as many DDGs. And I know people love to tell me that DDGs do not displace corn for feed use, but they do, right? We know it's a feed source. If we weren't able to use that byproduct of ethanol, we would feed real corn, actual corn into that mix. And so it does displace corn. So by lowering feed use or by lowering ethanol production, we lowered dried distillers grains. We probably picked up some real corn in that case as well. Some unusually high real corn numbers. So good question.
Great. And she's answered back, as always, thank you for your insight. We will miss you, but best of luck.
Thank you, Angela. Appreciate it.
Okay, I'm not seeing any more questions at the moment.
Did Aaron get in?
Wait, we got one.
Oh.
Ken Schwartz, we have good NC prices now with wheat at 6+, corn at 4+, and beans at 11+. Should we be locking some of our crop up at these prices?
Ken, yeah, that's a good question. My answer would be we're profitable at those levels. I do think that, those are price supports that many people would be happy with. The one that I'm maybe nervous at a little bit, and here would be my recommendation, is I do think, there is still upside potential, especially on probably, and again, I'm favoring this more towards soybeans because I'm giving the acreage edge to corn. For some more upside potential on soybeans, at least as we head into the growing season, we potentially could be in a scenario where we have to import soybeans because we don't have physically enough soybeans to meet our domestic needs. So we're going to see some basis appraisal potentially in that case as well. But the downside of this is that Brazil has a mammoth crop, right? Like that's the downside of it. So I look at and we plant a mammoth crop. Maybe I'm wrong on acreage, and we ended up planting 94 million acres of soybeans instead of corn. So I think, the reason I wish I could give you a better answer on that is I just don't know which way we're going to go on acreage. We haven't had a year like this where both crops are as profitable as what they are, to get a clear signal on what people would do if they were in this scenario. So, my answer is, yeah, I would lock in some, but that's just me. I'm risk averse. That's why I'm an academic and not farming. For those of you that farm, I applaud you. That's a very noble calling, but certainly you take on more risk than I do. If I do something wrong, I just get a hand slap. Your guys' business is in the line. So, if it was me, yes, I would do it, but certainly make a decision that fits for you. So.